Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guy who's been kind of a regular guest on the show. He owned a big company, a big tech company, sold it for a mint. He started a market-ticker.org, prolific writer. At one point, he was writing 3 or 4 articles a day. Now he writes 3 or 4 articles a week, but still, that's prolific on the internet. I'm talking about Karl Denninger. Karl Denninger, thanks for joining us today on USAWatchdog.com.
Thank you for having me back on.
I got a huge smile on my face because, I mean, you know a lot about a lot of stuff. You don't just write about one thing, but one of the things you came out, I want to say, 2012. This is before everything got fully rolled out. This year, everything gets fully rolled out in Obamacare, the disaster that is Obamacare, the biggest policy lie in history. But anyway, I digress. And early on, you said that Obamacare would be a huge drag on the economy. No matter what, it's going to be a big drag on the economy. And now it's not only is it a drag, but it likely will implode this year or early next year. Tell me what's going on, what your appraisal is of the health care debacle that the Republicans swore they would repeal, and now they just can't do it.
You got to look at the underlying problem with health care is not insurance or so-called access to insurance. It's cost. We have a section of the economy that went from 3% of GDP, everything produced in the United States, to about 19% over the space of roughly 30 years. And when you look at the data that's available, the most accurate data is that available from the Treasury on Medicare and Medicaid, because they produce, of course, a Treasury statement. If you want it on a daily basis, you can have it on a daily basis. The most instructive part of that series is the monthly Treasury statement every September, because that's when they close the fiscal year. So if you take the September monthly Treasury statements and you start picking data out of them, you can get a very good idea of what trends look like. And back in the 1990s, we were seeing acceleration in healthcare premiums at my company, 8, 10, 12% a year. We had a string of years where we never saw an acceleration that wasn't in the double digits. And I started looking at what the government was spending on their programs, because one of the common chestnuts was this is mostly in the private sector. Okay, this is basically greedy insurance companies, greedy hospitals, greedy doctors, blah, 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 blah. And Medicare and Medicaid, of course, kind of dictate prices because they have a cartel sort of situation going on. And so that was the allegation that was being made. When I looked at the MTS, I said, oh, wait a minute, this is a lie. Medicare is expanding at 9, 10% a year. And by the way, so is Medicaid. And the other big lie that has been told over the years is that this is all people getting older and sicker. And if that was the case, then Medicare would be going up at a much higher rate than Medicaid, because, of course, Medicare is old people and Medicaid is poor people. If you are poor, when you get old, you go on Medicare, regardless of what you were on before. So by definition, people that are on Medicaid are now 65, with a few exceptions. There's some places where there's overlap. But for the most part, that's true. And that pattern has persisted. So Obamacare managed to buy 1 year of smaller expense in Medicare and Medicaid. Just 1 year. And then it went right back to the previous trend. You take that 1 year out and essentially throw it away, and you look at the average growth rate since 1998, which is what you can get to right now on the MTS series. You can go all the way back to 98 from what's published online. And you find that those expansion rates were in the mid-8s. So this is a 8+% every year expansion against economic output that's growing today at 2.
The Atlanta Fed just said it was 0.9.
Well, we will not have accurate numbers. And first quarter, of course, doesn't mean a lot by itself. You have to look at the whole year. But since the crash in 08, we've had 2% GDP expansion roughly on an average basis, and you're trying to expand the expense of one program in the government by 8.5, that's not going to work. And so this is the problem you have. And what Obamacare has done is essentially caused the 2% expansion, because if you think about what goes on in the private economy, GDP expansion, the expansion of output, is two things. First, it's a function of the money printing that goes on. because you measure GDP in dollars, but if the number of dollars in the economy is not a constant, then basic algebra says that you have to back that out in order to be, in other words, you have to divide by the number of dollars change in order to get a clean read on whether or not you're actually producing more stuff. Because what I care about is how many gallons of gasoline are made, or how many doctor's visits, or how many cars or television sets. I don't care how many dollars they cost. And, this is the argument I made for a long time. You don't care how many dollars you get paid. You care about how much electricity you can buy, or how many groceries you can buy with what you earn. But the second part of it is that when you start transferring money around, you destroy productivity expansion, because you delete the incentive for people to advance their own personal productivity. So what has happened here is that we've taken this program and crammed these costs into the economy on a mandated basis. And the result is that productivity expansion has gone in the toilet, because we have both been printing money in order to cover the deficits, and at the same time, we've been expanding the transfer of wealth from one place to another. And the outcome is that we've had almost 10 years of 2% GDP expansion, which is terrible. And remember that at the end of the day, productivity growth is what makes everything work, because it is the ability to do more with less. That's the definition.
And you're saying that when you hear that the President Obama is the first president ever to have never have a 3% growth in the GDP, and you're saying he can blame it on Obamacare. He can blame it on himself. That's the whole reason why we never got any growth, which is what you were predicting in the beginning, that it was going to be I think you said it was going to be a boat anchor or a huge drag. I know you said that. It was going to be a huge drag on the economy, and that's the reason why we never were be able to sustain any liftoff speed with the economy, is because of Obamacare.
Yeah, but you got to understand why Obamacare was passed. Obamacare came into being and was written by the insurance and medical industry because the high risk pools that were out there in the 1990s and early 2000s were in the process of collapsing. The idea behind this was that if you had some serious condition and couldn't get insurance, that there were state-funded pools that were largely funded by cost shifting. And so if you had HIV or diabetes or something like this that prevented you from getting traditional insurance because you just couldn't pay for it. And remember, insurance is for things that haven't happened yet. If you start mandating that people cover an event that's already occurred, the cost of running that through an insurance company is always higher than paying cash, because the insurance company has to make money or it goes out of business. So when you say that an insurance company has to cover pre-existing conditions, what you're saying is that if this condition costs $10,000, we're going to make it cost $12,000, because the insurance company has to make money. The cheapest way to pay for a condition that costs $10,000 is to stroke a check for $10,000. That's just basic math. And yet nobody wants to deal with this. So the high-risk pools were in the process of collapsing. And as a result, you had Obamacare that came in to essentially force everybody into the risk pool. That was the whole point, was everybody has to buy, and therefore we're going to take things that you can't get. For example, as a man, I can never need maternity. Okay, that's something I can never need. A woman can never have prostate cancer because she doesn't have a prostate. So as a result, if you have these things that I have to pay for in my coverage, but the probability of them happening is zero, then what you've done is stolen the money for that from me and given it to somebody else.
And is this why that none of this is going to get passed? I mean, I've been saying on my weekly news wrap up about the 10 essential services. They're essential because it's essential. Somebody else pay for them. And is this why there's just not, because what we ought to have is just a catastrophic policy, period, the end. Here's what you get. And I don't know how to take care of the pre-existing condition people, because basically what they want everybody else to pay for it. Is this ever going to get fixed? Is this ever going to get fixed? It's not going to get fixed. It can't be fixed. It can't be fixed where everybody's happy. That's for sure.
Well, no, wait a minute, Greg. That's not entirely true. There's going to be a few people for which it's very hard to fix. But let's back up a bit. The problem is that the costs are too high.
Yeah.
And the reason the costs are so high is because you have what amounts to a racketeering enterprise in medical care in the United States. It is illegal for you to take your car to a car dealer and have him tell you, you say, well, the engine is making a weird noise. And he won't give you a price. Okay. He says, I'll tell you how much it's going to cost to fix the weird noise in your engine after I fix it. And oh, by the way, how much you pay depends on which car insurance company you have your car insurance through. If you have it through State Farm, and you won't know this until after I fix it, you'll pay $200. If your car insurance is through a USAA, you'll pay $50. If your car insurance is through Geico, then you're going to pay $1,000. And if you don't have car insurance except for a basic liability policy because maybe you had too many wrecks or you got a drunk driving conviction, so you have SR22 insurance, it'll be $10,000. That's what goes on in the medical system today. It's illegal everywhere else. If you had a gas station that wouldn't tell you how much the gas costs until after you pumped it and you had to pay them because the gas was already in your tank, they wouldn't have anybody that would ever go there. If all the gas stations in your town got together and did this, they'd all go to jail. Well, hello?
Is there any way of fixing this? Is there any really way of fix the way it is, the way it's set up now? Repeal Obamacare, replace Obamacare. There's going to be a lot of losers in this because the cost cutting is going to fall on people that need the insurance the most.
Well, now wait a minute. Remember, insurance is only appropriate for something that hasn't happened yet.
That's right.
If I want to buy fire insurance on my house and I just lit the house on fire, then the cost of the insurance, say my house is worth $200,000, the cost of the insurance is $220,000.
Yes,
because,
that's a great point.
Yes, because the insurance company has to make money. I ought to just stroke a check for $200,000 and be done with it because I'm going to pay more no matter who I run the payment through. All right. No one works for free ever, anywhere, period. End of discussion. That's it. Now, the problem is this. Today, let's say you get cancer and the doctor says, well, you have to take this chemo and this radiation therapy. By the time they add everything up, it's $200,000. There are very few people who have $200,000.
Yeah. There's very few people that have $2,000.
Now, wait a minute. What if it's 20?
Yeah.
You could probably figure out a way to finance that. You could also buy insurance against it because the probability of you getting cancer in a year is less than the probability of you wrecking your $20,000 car, right?
Yep.
So it would be cheaper to buy insurance against cancer or any other weird, rare disease or something you haven't had happen yet than it is to insure your $20,000 automobile because it's far more likely that you're going to destroy the automobile than get the disease.
That's right.
So where's the problem? The problem is that the event costs $200,000. Why does it cost $200,000? Because the doctor doesn't have to tell me how much he wants to charge me before he does whatever he wants to do. And if he had to do that, if he had to give me a price, I might say, you know what? That's too much money. And so I go down the street and I start shopping and I look at the price that some other doctor wants to charge me for the same thing. If you had a law that said that it is against the law to charge people differential amounts of money for the same service, which, by the way, is the law when it comes to goods. It's called Robinson-Patman. It's embodied in 15 United States Code. That kind of thing is illegal. Commodities that are discriminatorily priced for purchasers of like kind and quantity is against federal law.
Prediction. Do you think this gets fixed in any way, shape, or form at this moment? Do you think the healthcare system will get fixed? Or is Obamacare just going to, as Donald Trump says, implode?
Well, I don't think it'll get fixed at the present time. And the reason I don't think it'll get fixed is that if you did this, if you went out and you said, everybody has to publish a price. So in other words, I can go on the web and I can look up how much X, Y, and Z costs. Okay. There are, by the way, concierge places where you can do this today. So I found one recently. X-ray is $37. That's not a bad price. Why are the bite wing X-rays at my dentist's office $143? I want to pay $37 because $37 is cheaper than $143. I'll drive across town to pay the $37 and then take the X-rays to the dentist because he just wants to see the X-rays. Where they come from shouldn't make any difference, right? So I should be able to buy the X-rays for $37 instead of $143. Oh, by the way, that's almost a 75% discount from what I'm being charged today for the same thing. This would happen throughout the entire medical system. Another couple of examples is a CT scan for $167 and an MRI for $275. Both of those are a tenth or less than what you get charged today, even with traditional insurance. And if you have one of those high deductible plans, guess what? You get to pay every penny of it until you exhaust your deductible. So we can solve this problem right now. But if you do it, what happens if you take 19% of GDP and make it 3%?
Economy takes off.
Well, what happens?
It gets redirected, doesn't it?
Well, yeah, but what happens the day you do it?
Somebody loses money.
There's this thing called an economic depression that happens because the economist's definition of depression is a 10% decline from top to bottom.
So this is not going to get fixed anytime. And your prediction is the healthcare situation that they have royally screwed up is not going to get fixed anytime soon. Is that right?
I don't believe it will, and therefore the only defense you have against being destroyed by this personally is to become completely independent of the healthcare system, and therefore your middle finger goes up. You just refuse to participate. And if you get ill enough that you have to have healthcare of some kind, you need something serious done, you go wherever you can get it for cash, whether that means somewhere like the Oklahoma Surgery Center here in the United States, or you get on a plane fly to India. You can have a bypass done in India for $2,500, including everything. And the complication rate for the surgery there is lower than it is here in the United States. You can have it done at the surgery center in Oklahoma for $10,000, by the way. The hospital will charge you over $100. There is a huge difference, though. The surgery center's price includes any possible complications. In other words, that $10,700 is all you're going to pay no matter what happens. Now, think about the logic behind this. If I'm a heart patient and I need to have my cardiac artery bypassed, okay, if I go into a regular hospital and I get an infection in the hospital gets to bill me for treating that infection. That's under the current system that we have. If I go to the surgery center of Oklahoma, I pay the $10,700, and that's all I pay. If I get an infection, the cost of treating that infection is on them instead of on me. So which one of those two places has a better incentive to make sure I don't get an infection?
Yeah, you got it. Let's move on to the economy. The stock market just looks punch drunk to me. Gold is catching a bit of a bid. There all kinds of talk about the AIIB, the Asian Infrastructure Investment Bank, getting up. The yuan is going to start to be used. Looks like people are moving away from the dollar. We got $20 trillion in debt. Well, your appraisal of what's going on in the economy, are we going to have a crash, or can Donald Trump pull it out and turn the economy around somewhat?
Who's moving away from the dollar? You look at the DXY lately; it's hovering right around 100. When was the last time it was there? In 2007, 2008, it was trading around 75. The dollar is being moved away from. Says who? The crazies that are trying to sell you gold? It's not happening. But here is the problem you have today with the markets and the economy in general. We have a valuation bubble that is worse than 2000 right now in the general equity markets. Why is it there? Because you have the same kind of algorithmic nonsense that was going on in 1987, just before the 1987 crash. They called it portfolio insurance then. When the market started to go down, the algorithm shorted futures. Well, today you have these correlated algorithms that are doing this all electronically. They don't have to send orders to a floor for somebody to bark out anymore with hand signals. Now it's all being done by computer. And so as a result, every time you get a little bit of volatility, a little bit of a dip, here comes the algorithms because they are there to balance this out. Okay, where's the problem with that? The problem is it only works as long as the correlations hold up. The minute they break, everything goes the other way. And that's what happened in 1987. It's what happened in 2000. Arguably what set off the 2000 tech crash was this little dog squeeze company called MicroStrategy. By the way, they're still around. That reported that they were going to have to restate earnings. And all of a sudden, everybody woke up and said, hey, wait a minute. I mean, if you think about it, in terms of market cap, that was a nothing, okay? If you think about Lehman Brothers in terms of actual size, they were nothing. They set off the crash in 2008, and yet in terms of the actual economic impact of Lehman Brothers disappearing, didn't mean anything at all. So this is the same sort of situation we're in today. Nobody knows how long it will go on, but you are in a place right now with record margin debt in the United States that's very, very dangerous because at the point that margin calls start, the cascade is almost impossible to stop. I don't know what you do to prevent a cascade of margin calls because the margin clerk calls you on the phone and says, put 200 grand in your account within the next 30 minutes by wire transfer or we're liquidating all your positions. And you don't have 200 grand. So they sell everything you have. That just adds more selling pressure to what's already going on.
Do you think that the ECB is going to trim off their bond buying, and do you think that could start a cascading event? All the derivatives out there, which is big. I know you know all about this kind of stuff. Do you think a derivative meltdown, by what you said, margin calls, liquidation of accounts, interest rates spike? What do you think about that? Could derivatives melt down the markets?
Yeah, I think there's a lot of risk out there. The VIX, if you look at the volatility index, it's every time it starts to move up, it gets slammed back down. And again, this is algorithmic trading that has been working now for the last 7 or 8 years. This is the way people on Wall Street tend to be. They find a pattern, they back test it, and they say, oh, look at me, I'm the smartest man in the world because I've got this pattern and I've got this algorithm and you can't lose money and da-da-da-da. And all of that works right up until it doesn't. But the ECB at present is facing a little bit of a problem because their inflation targets have been exceeded. And so you've got things running very hot over there, but you haven't solved any of the underlying issues that they have with countries like Greece that still cannot meet their target requirements. And so you've got imbalances throughout the system. You have the Federal Reserve, which is essentially in a position where it has to start taking risk off the balance sheet because at the present time, the danger they have leaving their balance sheet where it is that they become the market for treasuries. And at that point, you may see a situation where benchmarks that currently get pegged there become uncoupled. For example, in the mortgage market or in the corporate bond market. That would be extraordinarily disruptive. And
in other words, interest rates. In other words, interest rates spike up.
Not necessarily in the Treasury area, but in the real economy, yeah.
Mortgage. In other words, you're saying that mortgage rates could spike. We could go from around 4% to 4.5% or 5% or something like that. That would cause a cascading event, would it not?
It could, but I think the more likely situation is not that it happens so much in the mortgage market, but it happens in the corporate bond market. And the thing is, the bond market is multiples of the size of equities. So if you're going to protect something, you protect the bond market. You don't care what happens to the stock market in comparison because it doesn't mean anything.
So where do you think we are right now? You think that we are things getting better, or are you running for the hills and pulling in your stock portfolio and going to cash or whatever?
Well, I think we're in the same sort of place we were in 1998, 1999. The outcome of this is. We all know how this party is going to end, right? The building's going to catch on fire, and the door is one person at a time wide, and there's 15,000 people in the room. Uh, the problem is figuring out how far it goes. In '98, I got out of the internet business, and all through '99, I had people telling me, as the Nasdaq doubled. Oh, look at how much money I'm making. Look at how much money I'm making. Well, did you sell any of this? No, because it's still going up. And I said, well, none of that's real. It's just a number on a piece of paper. You can't spend that until you sell those positions. Well, but I'm getting richer every single day, so why would I sell any of those positions? And then, of course, 2000 happens.
Well, do you think that? Do you think we're close to that again? Do you think we are on the precipice of a big disruption?
Yeah, but I don't know when it gets set off. I mean,
you've always said in the past that we never get to the wall. You were talking about the housing crisis in 2008, which I thought was fabulous, and you said that, and I thought this was really insightful. And you said, we could have gone to 2010, maybe 2011. We didn't. But somebody woke up one day and went, "Oh my gosh, sell, sell, sell."
That's always what happens, Greg. And the thing is that when I look at the budgetary side of things with Medicare and Medicaid, for example, we have another 5 years or thereabouts at present trends before we get to the point that the federal government cannot finance what they're doing. But we won't get 5 years. Okay? The problem with what's going on in Congress right now is that at the point the market wakes up to the fact that none of this is going to get resolved at all, ever, that's when it comes apart. Because at the point that you realize that the federal government is going to try to run another $600 billion a year in deficits in 5 years, it's going to go to $2 trillion a year in 10 years, and they're not going to change course. You may as well get out of it now because the outcome is certain. When does that recognition happen? I don't know.
Are you out of the market right now? What are you doing?
I mean, do I occasionally trade things on a short-term basis, something I can liquidate in 30 seconds? Yes. Would I hold long-term equity positions at today's prices and today's positions? No. If you have to go to work and you can't keep your finger on the button, risk reward is in a bad place right now. The PEs are very high. The growth numbers are very low. You have companies that are essentially extracting from their balance sheet by using buybacks and debt issuance. This is not R&D expenditure that's driving innovation and productivity growth. And the fact that they're not innovating and driving productivity growth is showing up in the GDP numbers. So there's the proof.
Are you worried about a bond meltdown?
Not directly. I think, the more likely scenario is that the equity markets and the bond market both wake up to the fact that the paralysis, not so much from a standpoint of the GOP, because I think the GOP will eventually start passing bills and Trump will start signing them. All right. Of course, that's not what happened Friday, right? But I think that will eventually start happening. The problem is if they don't address the underlying driver when it comes to healthcare, which is in cost. It's not an insurance access, it's cost. If they don't start putting handcuffs on people within the next couple of years, it doesn't matter what else they do.
And you're not a fan of gold, but do you have any gold, any physical gold, 5% or of your portfolio or anything, just in case the worst happens, the hyperinflation or massive deflation or whatever? Do you have any gold? Would you suggest any gold?
I own zero. I own no precious. I own no precious metals in any form, physically or through any kind of financial product, and I don't see the purpose in it, because if you end up in a situation where it becomes necessary, the one coin you have sewn in your jacket hem will be the one that you bribe the guard with as you try to go over some border somewhere.
that's what Catherine Austin Fitz says. Go ahead.
Well, and the problem is that if you're carrying a whole bunch of them, the price of getting over the border is going to be all of them. So, that doesn't do you any good. And the reality is that the solution to this problem is found politically, and it's found in getting off your butt. If you try to be defensive personally, you're going to fail, because at the end of the day, if I've got a pile of gold and you have 10 chickens and the entire world goes to hell in a handbasket and I can't go to the grocery store and buy chickens, the balance of power is on the person who has the chickens. It's not on the person that has the gold coins.
So you got a chicken coop on your property. I'm just kidding.
I think it makes a whole lot more sense than having a pile of gold coins.
Okay, that's the opposing view. And a lot of people on here think gold and silver is a good thing to have for a long-term core asset. But I appreciate your candor and your analysis on that. Karl Denninger, the website market-ticker.org. Karl Denninger, thank you for taking us to school on healthcare and that proverbial hitting the proverbial wall, which is not that far away. Thank you, Karl Denninger, for coming on USAWatchdog.com.
Thank you very much for having me.